as Nigel highlights. 55 points, by the way, on the index. We're at about 19,720. Vinay Jaising is Managing Director, Portfolio Management Services at JM Financial. He's with us with what he's making of things. Thanks very much, Vinay. Always a pleasure having you with us here. I don't know if you heard a little of what Mark Mobius was telling us earlier. 20% weight here in India, is an emerging market veteran and resolutely bullish in that sense, Vinay. What's your own kind of thought process in the slightly near to medium term with all that is happening globally?
So thanks so much for the opportunity. Yes, I did hear the interview. Very interesting. He comes, from one of the few, global fund houses wherein you have such a high overweight on India. If you look at the overall FII position in India 2 years ago, they were owned about 20+% of India. Currently, it's gone down to about 18%. So they're relatively much more underinvested in India as compared to the past. Clearly, the dollar moving from 70 to about 82, 83 is being part of the pain. And they did take out, apart from this year, in the last 2 years, about $24, $25 billion as well. So there's an interesting 2% catch up for the rest of the world if they move, towards the way other FIIs are doing. And you could see as much as $80 billion coming in the next couple of months from that. Also, what's been very interesting has been the bond inclusion, the JP Morgan EM fund, which could get another $20 to $25 billion money coming into India. So good times of liquidity coming into the country. I think that's the first way to start. Having said that, India has been the best performing market in the last 3 months, 6 months, FITD. Overall, the world has gone up by only 2% FITD and India is up 16%. I'm talking about MSCI India. Small cap and mid cap are up 30%. So for a small amount of time, you could see some sideways movement, whether it's short term or medium term, a little difficult. But as the earnings trajectory keeps on moving towards India and everything's pointing to 15-16% CAGR in earnings this year and next, you'll start seeing, after probably a small time correction, you'll start seeing the markets also move northward, upward, as we move towards elections. And I think the next two key risks for us to look at is what happens, as far as crude oil prices are concerned, and the election outcome. All of them from short term to the next 12 months, a lot of action I think we would see as far as India is concerned.
All right. Good to hear your thoughts, Vinay, and thanks so much for joining in. Well, by the way, as we speak, we're having this chat with Vinay. We have the Nifty Bank that was under pressure. It was down more than 400 points in the morning. That's recovered and that's moved into the green. Remember, that one's playing out expiry today, given that it's a Wednesday. So the Nifty Bank is the one that's driving the Nifty higher. And also a couple of other stocks. You have HDFC Life and ITC. Both of them have moved to the high point of the day. Vinay, I believe that you're constructive on HDFC in particular. HDFC Bank, that's been a rank underperformer. If we pull up the Nifty year-to-date chart and we'll pull up, say, HDFC Bank, that'll tell you the picture out there. You're constructive. Would you be a buy on HDFC Bank at these levels? And what would be your broad time horizon? Because in the near term, there'll be some pressure on the NIMs, on the return ratios as well, and maybe on the asset quality front as well.
Thanks, Nigel. It's exactly what you said. We've seen a mammoth come up of HDFC Limited and HDFC Bank merger. The weightages and indices are obviously too high. If you look at, the large cap indices, they're as much as 13%. When you go to the 500, BSE 500, it's 8 to 9%. But MSCI India, it's about 5 to 6%. It is one of our largest positions in our fund. The reason why we've been buying or we own the stock is, one, valuations are our way. It's probably at a 5-year low in terms of price to book, about 2.6, 2.5 times. Very quality management, that's 2. Here we're talking about India relatively having outperformed its peers and valuations being a question mark compared to emerging market. Remember, we are at a 70% premium, and here there's a stock at a 5-year low. Third, if you look at what HDFC has done in its announcement with HDFC Bank, what we understand is HDFC Bank has been a little conservative in accounting, and courtesy the merger, you've started seeing the book reduced by about 4%, which is not a substantial number, and it's more a catch-up impact which will happen in the future. Also, I think the fourth point where I think the market is reading too much about it is the NIM contraction, partially on account of the amount of liquidity they had to raise. Remember, it came at a time where the incremental CRR was raised by 10%, and that itself is weaning away. So you may see the market get pleasantly surprised when they see the loan book growth, which stood at 13% when you looked at the two companies together, inch up to 15 to 16%. Also, you start seeing liquidity improve in the banking system. Today, we are at net negative about 150 billion. But as that gets done, you'll see the costing pressure for HDFC also moving down. And I think you'll go back to better quality performance. It may take 2 quarters. We may be a quarter early for this, but I think this is something, considering where the market valuation is a must-own in one's portfolio.
Must-own in one's portfolio. Vinay, you own a bunch of defense names, Bharat Dynamics, BEL, MTAR, and they've done very, very well. Any changes, any additions? I mean, shipbuilders, for example, they started late, but they more than made up for the late start. Your Cochin and Garden Reach, etc. Since you have exposure here, have you kind of looked at expanding it, adding more names here?
We've incrementally, increased our cash position overall to about 9% currently in the NDPMS portfolio. Yes, these stocks have done well, and relatively valuations are still compelling for us to buy them. The story longer term or even medium term of a strong order book for the defense sector remains with it. Valuations at one time when we were buying it were at 15 times. Now they're at about 22 to 25 times. Even after a slight correction, MTAR is at 30 times. But the earnings trajectory for them is where we're excited for, and return on capital employed as well. So yes, we keep on nibbling at these stocks, but they are a sizable portion of our portfolio currently, and we are very happy to own them currently. We haven't added any new stocks in the defense name in our portfolio.
You said your cash holding is 9%?
That's right. In our NDPMS.
And this is higher than what you would typically have, right?
That is right.
So what positions have you trimmed in order to increase your cash holding?
We've trimmed a little bit of our energy space. We are now very underweight in energy. We've trimmed a little bit of our IT space, and where, some of the stocks, remember we run a PMS, so individual stocks, when we buy it for some investors, some of the railway names, some of the defense names would have gone up to very high levels. So purely in terms of risk management, we would have trimmed a bit of that as well. It's interesting, we currently, with this cash, are looking at a lot of interesting names to buy. We are seeing some corrections happen on them, and we're looking forward to deploying it pretty shortly.
Do you want to tell us a little bit more about the stocks that you're evaluating, or the themes that you're evaluating where the risk reward is reasonable?
Sure. There is a listing of a new IPO which we've started nibbling in the form of Concord Biotech, a global fermenter, very strong market shares both domestically and globally, great return ratios, bottom line growth arguably between 25 and 30%. That's something we are looking at. We find that very interesting. One of the big banks, we own that, and we keep on buying that, is IDFC Limited. There's an arbitrage there with the bank as well of 15%. So a couple of interesting ideas between banks and the pharmaceutical space, which we are looking at. One of our favorites is specialty chemicals, courtesy China, which is still not doing as well as we wanted to. Tatva Chintan, we are looking at that pretty aggressively as well.
Always good hearing your thoughts, Vinay. Thanks so much for joining in and sharing all of them. Wishing you a good evening ahead, and looking forward to hearing from you rather soon. Well, time to move on then. It's that time.